All right. Today is Wednesday, May 24th. This is a recap for the stock market activities today. And folks, I got a good one for you tonight. We begin with what else? How about NVIDIA's earnings? After the bell, NVIDIA is up about 27% at the time of the recording of this video. And I believe in the conference call, which I have yet to listen to, the word AI was mentioned over 50 times. Now, the after hours gain for the stock is worth about $250 billion, almost. So we have a value worth $250 billion created in the after hours session alone. And this is bigger than the budgets of advanced countries such as Sweden, Denmark, Portugal, and many more. So the company must have aced earnings, even crushing Apple's earnings and revenues and profits and all of that, right? Well, the answer is not quite. If we look at the revenues for NVIDIA, and this is the year-on-year, data center up 12.46%, that's good. Gaming down 38.12%, that's bad. Professional visualization down 52.57% year-on-year. Auto, another bright spot, up 53.37% year-on-year. OEM and other, the revenues were down 51.26% year-on-year. All in all, the company's revenues year-on-year grew negatively, down 13.22%. So Maverick, what's going on here? This doesn't make sense at all. Why is the stock flying high after hours, creating a value of almost $250 billion? What's going on here? Maybe it's short covering. The answer is not really. If you look at the options market, there were no shorting at all. The put volume was a lot lower than calls. And even if you say it's a gamma squeeze, the calls volume was not that impressive at all. It seems that there was a mood of hesitancy before this report came out. But here's what made the difference. Again, you can see that the net income is down 20%, income down 13% year-on-year, but NVIDIA CEO is now expecting $11 billion plus or minus 2% in the next quarter, not the year. In the next quarter. Now, NVIDIA never seen such a number before. The highest they got was about $8 billion in a single quarter. So this is a massive, massive upgrade. $11 billion in a single quarter. This is for the next quarter. In other words, the company is seeing a massive stampede in AI orders. Actually not. They haven't given us any tangible reason why they're getting to this number. They're not saying we have a number of orders that justifies 11 billion in the next quarter. They're just saying we're predicting that this will be the number in the next quarter. In other words, NVIDIA raised the bar way too high, and I believe they raised the bar way too high for themselves, because who's putting these orders? We didn't see an increase in expenses for Microsoft or Google or Apple or Amazon or Meta. All of these companies are rushing to cut costs, not increase them. Now, another plausible explanation is maybe these chips cost a lot more, so there is a massive pricing power happening in the second quarter, at least in the orders that are taking place right now. That could explain it, but then the question becomes, are they going to maintain this pricing power in Q3 and Q4 and beyond? All of these are good questions, folks, but I don't have an answer for you. I was surprised by the number. I thought it was a typo. $11 billion? Maybe they meant 8.1, because they've never delivered $11 billion in a single quarter. We'll see what happens, but for now, the stock is up about 25+%. Again, creating a value of over $200 billion. In other words, NVIDIA created about 3 microns, almost. Micron's market cap is $70 billion. NVIDIA created about 3 microns during the after-hours session alone. We'll see what happens, folks. Again, are people going to dig into this number and say, how did they get to $11 billion? We'll see. But for now, I suggested a trade because a lot of you were buying like 200 puts, 100 puts, betting for a crash in NVIDIA. And I said, folks, while many are betting for a crash in NVIDIA and buying ridiculous out-of-the-money options, 200 puts and below, with a weekly expiration, mind you. I hope you're right, but you gotta be realistic. And I could have said the same thing for call options buyers, by the way, buying the 400 calls. But the insanity happened on the way up. The good news is, I said if you want to speculate, use a spread such as the 275, 270 puts expiring this Friday, which will cost you about 40 cents a piece, and then buy the 335, 40 call spreads, same expiration date, which will cost you about 60 cents a piece. All in all, you got exposure in both directions, and it costs you only $1 a piece. Now, had I known that we're going to blast higher to this magnitude, I would have said, okay, increase the gap between these strikes. But the implied move was for 6%. I went even higher. I went to 10% in either direction. But again, this $11 billion number came out of nowhere. And I think it shocked the market. We see an oversized reaction to the upside. The good news is if you followed this trade, you're going to be up about 400%. That's not a bad return at all in a single week, but there is a risk of assignment. So please, as soon as the market opens tomorrow, close these call spreads because you already have a ceiling. The cap for these gains is about 400%. That's it. It's not going to get better than that. But if you stretch it, if you keep it, you're going to get assigned. You don't want to do that, especially if you're new to options. You might get into a margin problem. Your broker might close both for you and nothing will happen. But just in case, close them, book the profit, get out. And then we'll see what happens with the stock. Now, let's talk about this market because right now, it appears that the market almost erased pretty much the entirety of the gains from the unexplained trade that we got last week, which made for a perfect trap because it gave us false signals of breakouts. And then we went down anyways. We'll see what happens if the market keeps the NVIDIA enthusiasm tomorrow or not, because we also have the debt ceiling. That doesn't look good right now. Every time they come out, they say we're optimistic that we're going to get a deal. No, we're not going to get a deal. You got McCarthy in one hand. He says take it or leave it. And Biden has very little room for maneuver. The other outcome they're talking about right now is maybe the date, the X date, June 1st, is not really accurate. Maybe it's going to be June 10th or June 15th. Or we can kick the can down the road. That's not going to change anything. At the end of the day, these two parties are too far apart. And I don't know how they're going to get to a deal. Honestly, somebody has to capitulate. Somebody has to endure massive political loss. Is it going to be McCarthy? He has some room for maneuver. Now some Democrats say, okay, McCarthy, if you capitulate a little bit, we'll support you. We'll pass the bill. We'll raise the debt ceiling. But McCarthy will be dead. He has one fan, shall we say that, in the right wing of his party. That's MGT. MGT obviously has a crush on McCarthy. She bought his lipstick for $100,000. Kind of creepy. He doesn't seem like he's really into her. It's like that high school girl who keeps chasing you and like, honey, I'm just being nice here. I'm not really into you. I'm into the other girl, but she doesn't like me. That's how it always works, right? The ones you don't like, they're into you. The ones you like, they're not. Anyways, he might need her vote at some point, but will it be enough? She will look like a hypocrite to her constituents. And what about the others? The Gates, the Boberts of the world. They're going to kill McCarthy. So he doesn't have a room for maneuver. The only way this is going to be resolved is if Biden capitulates, which I don't see happening either because there is a massive political cost. He's running for re-elections. So it seems that we're heading to the 14th Amendment. Now, this is a new episode that we haven't seen before, and with that comes a lot of volatility. While we got some down days recently, 2 down days, maybe based on fears, maybe based on technicals that, hey, the move that we got last week was based on options. We're just correcting the divergence that took place based on that. Who knows? What we know is the market is extremely distorted right now. And when we look at the S&P equal weight versus the actual S&P, the gap is the highest since 1999. I wonder what happened back then. What are the implications of such a reading? It says that the S&P 500, if you take it as equal weight, is way underperforming the actual S&P. And the reason is the overvaluation and the outperformance by a handful of names, which happen to be the big caps. Other than that, the rest of the market is getting slaughtered. And another thing that we have to keep in mind is what's going on with the Fed. We talked about the Fed in details in the last video. The data, the facts, the logic say that the risk of inflation is still too high and inflation remains too sticky and the Fed will have to do more. And therefore you hear people like Jamie Dimon, for example, coming out and said, hey, rates might go as high as 6 to 7%. But now the Fed is playing this temporary game of tampering expectations of a Fed hike in the next meeting. They're talking about a pause or even a skip. Highly unusual. What's going on here? I think they're buying time. They know the fight against inflation is not over, and I'm going to show you the data in a minute, but they also know, and this is something that you and I are not aware of right now, but they see something that is about to blow up. And they want to mitigate that. If they raise in June, that something is going to blow up. So they need to talk the market down, tamper expectations, buy a little more time to fix whatever they're seeing right now. It could be a bank that came to the Fed and said, look, we're in trouble here. We're going to blow up. Can you help? Can you do something? It could be something related to the commercial real estate, for example. It could be whatever. We don't know, but it is a highly unusual move by the Fed. Because when we look at the data, for example, look at what's going on with the flash PMI that we got yesterday. We know that manufacturing is in a recession, and the reading that we got is 3 months low. So we have a recession going on in the manufacturing sector of the economy. Services is a different story. Services is where inflation is, because if you recall, commodities inflation went down, and therefore we see manufacturing is in a recession. Now, can manufacturing come back and become inflationary once again? The answer is yes, and that depends on energy inflation. If we see energy commodities increasing in price as we head to the summer season, and this is highly likely, by the way, since the employment market remains intact, the expectations should be for higher oil prices. If that is the case, we could see manufacturing revving higher to become inflationary again. But the services sector at a 13 months high reading is where the core of the inflation problem resides. And that's all up to the Fed. It's not commodities inflation. They cannot blame it on Putin or supply chains. This is due to the inflationary expectation psychology that we have embedded in the economy right now. This is due to wage inflation, which means the Fed will have to up the ante and raise rates even more to take services inflation out of the economy. So when people say to me, hey Maverick, maybe it is different this time around because we see the employment market being sticky, just like inflation. Could it be that we're going to see a soft landing? The answer is no. You should be terrified that the jobs market is not responding to what the Fed has already done. In a regular tightening cycle, the market should have responded by now. The fact that it didn't, it means that the Fed will have to do more. So when Jamie Dimon says 6 to 7% interest rates, he's not joking. That could be the case, and that will be the case because inflation is sticking and the underlying conditions for inflation are still here, meaning it can rebound higher so fast, so easy. Look at what's going on in the housing market, for example. All of these so-called experts who come out on TV and say, oh, housing is in a recession. Housing is crying uncle, according to Professor Kinder and Janelor, right? What are you talking about? In this channel, we said that the housing market is not in a recession. The housing market is the embodiment of inflation. All what's going on is there is no inventory, number one. Number two, the aggregate demand is waiting for a better opportunity. The moment new homes show up in the market, they're going to gobble them up right away. Here it is. The headline reads, home buyers gobble up new homes in April amid inventory shortages. And by the way, the moment the Fed cuts rates and mortgage rates go down, we will see the mania resuming like you have never seen before. New home sales jumped 4.1% to a seasonally adjusted rate of 683,000 units last month from the downwardly revised March rate of 656,000. That was 11.8% above the year-ago level. So you can see how easy the mania can resume in the housing market the moment the Fed backs off. So why would the Fed even entertain the idea of backing off? They're afraid that something is going to blow up. Now, you and me, we don't know what that is, but somebody went to the Fed and said, if you do it, something big is going to blow up. This is what's going to blow up. Give them a little time. Give them a little time, a month or two. Maybe they can raise some funds. Maybe you can sell some bonds, do something to avoid a disaster and buy more time. But it's all kicking the can down the road. At the end of the day, the underlying conditions for inflation are still alive. Look at the sensitivity to mortgage demand based on rates. We see headlines that mortgage demand surges higher the moment we see rates going down. When rates rebound, mortgage demand drops. And that tells you right away the aggregate demand is perhaps one of the strongest we've seen in years. They're just waiting for a better rate. That's all there is. They're waiting for the Fed to back off, to capitulate, and we will see an economic orgy like we have never seen before. And the inflation rate in the United States of America will surpass 10% rapidly. Part of me actually wishes I wish the Fed will do it. And the reason why part of me wants them to do it is to silence the perma-morons who say that inflation is dead. I wish that the Fed will not only pause, but cut rates 100 basis points immediately so you can see it with your own eyes. So when you go back to the grocery store, you have to give up your kidney at the cashier. Forget about the credit card. Today in the morning, if we look across the Atlantic, we talked about the Bank of England and the cooking operation. For some reason, the chief of the Bank of England said that, inflation is going to go down rapidly in the next reading. Well, how do you know that? How do you know that besides you're cooking the data? And even with the cooking, the reading that we got today for UK inflation was absolutely shocking. Sure, headline inflation went down from 10% to 8.5%, I believe, but you look at food inflation at over 19% year on year. Absolutely shocking and a rude awakening moment for Prime Minister Rishi Sunak. Rents are exploding higher in the UK at their fastest pace on record. Folks, can you imagine what will happen if the Fed indeed pauses or cut rates? Can you imagine what will happen to the UK? Because commodities inflation will rev higher right away. Inflation in this country will go back to 10%. Inflation in the UK will be at 20% plus with a single mistake by the Federal Reserve. And today we got the minutes from the last FOMC, and in summary, we don't know. It could be this, it could be that, it could be up, it could be down. We have no idea. Hey, AI, ChatGPT, can you help us out? That's what the minutes say. They want their cake and they want to eat it too. Oh, we're going to pause, we're going to buy more time or skip. But at the same time, please don't read this as a signal of rate cuts coming. Doesn't work that way. I promise you. Promise. The moment they pause rates, you will see oil prices exploding higher. And we'll talk about the news about the Saudi prince warning the shorts. That's another fiasco. We will see oil at 100 easily. Now, luckily for us, we have some rationale that is showing up in the expectations at least. You see, last Friday, before Jerome Powell came out with the paper shaking and twitching and all of that, reading the instructions from his handlers, the odds for a 25 basis points in the next meeting was at almost 40%. Jerome Powell read the notes from his handlers, and the odds went down to 13%. Today, they're back almost to 40% again. Can the Federal Reserve do anything right? Do they even have control over anything at this point? What a bunch of clowns. And this confusion, lack of guidance, lack of clarity, lack of conviction, lack of authority over inflation, most importantly, is what's causing this chaos. I mean, we're talking about a company, NVIDIA after hours. Sure, good company, but it created over $200 billion in market cap in a single day based on a hype, a prediction by the CEO that the revenue will go from a high of $8 billion, the highest they've ever gotten, to $11 billion. We have no evidence at all that supports this. You're already opening the path for rampant speculation. For now, the speculation is limited to the AI mania, but if you pause, if you skip, if you open the path for rate cuts, the speculation will come back to the commodities market, and that's when the game changes. And then what? The Fed will have to reverse their decisions and say, oh, forget about it, folks. We made a mistake. Now we'll do 100 basis points in a single meeting to catch up with inflation because it's coming back. Then you'll see more damage in the economy. Then you'll see more blow-ups in the economy. And in this episode of the revival of inflation, if the Fed backs off, you got to remember that the consumer is a lot weaker than before. So the consumer cannot really catch up with the revival of inflation. And what is the end product of all of that? The answer is stagflation. Anyhow, folks, I just came back from travel, so I'm opening these videos to the public channel, but we're going to go back to the regular schedule starting tomorrow. I didn't have the time to work on an in-focus segment, a separate video for the public channel, which I was planning to. And it's going to be about the US-China chip war. That should be coming out tomorrow on the public channel. And the market analysis, just like this one, will go back to the private channel. But for today, since I haven't worked on it, it's open for everybody. Anyhow, let's move on to the market analysis, and we begin with the closing of the indices today. And here we go. The Dow Industrial Average was down by 255.59 points, or a decline of 0.77%. The Nasdaq down by 76.08 points, or a decline of 0.61%. The S&P down by 30.34 points, or a decline of 0.73%. When we look at the sectors, down across the board. The exception is energy, barely positive. But boy, the laggards led by real estate, metals, industrials. When we look at real estate, we know that yields are moving higher. This is not good for REITs. You look at industrials and metals. We got bad news from China. The thing is apparently making a comeback. So all of a sudden, one of the cornerstones of the bullish theory is collapsing, which is the China reopening. For one thing, we know that the China reopening was a fugazi. The consumer is still weak, the spending is not good, and we see luxury goods stocks moving down big time, which means that European stocks will get a lot weaker. And now we have the double whammy that we could have another resurgence of the thing in China. And we could see more lockdowns, and hence we see metals, industrials down here in the US. Of course, you can see the wreckage in the casino names, for example. The Winds, the Las Vegas Sands, they're all down big in the last few days. We'll talk about that and a lot more in the heat map analysis. When we look at the breadth, the NYSE 19% advancing versus 79% declining. The Nasdaq 26% advancing versus 72% declining. Now, when we see such suppressed breadth, the expectations should be that we should see a bounce, and the stock market, the breadth at least, goes back to neutral, 50-50, and then we take it from there. Initially, I would have thought that's an easy call because you got NVIDIA after hours. But then we get the breaking news that perhaps Fitch is now putting the US on a negative watch in anticipation of the upcoming default. So we could see a risk of a gap and crap here in the market if we see, let's say, the Nasdaq shooting higher based on NVIDIA's earnings, but then we see a selling showing up in the market all in all because of the debt ceiling. Then we could see a gap and crap tomorrow. When you look at commodities, mixed picture, the dollar was higher, gains of about 0.5 percentage point, and therefore the most sensitive commodities to the dollar, metals, are down big. Be it the precious metals, gold, silver, down, platinum, copper, that's the scary one, down 2.5% today. So a double whammy against copper. The dollar is moving higher, and then you got the China revival of the thing, that's hammering copper real good. Palladium down over 2%. And the same goes for wheat, by the way. Wheat and grains went down by over 2.5%. If China's not going to consume, things are going to go down rapidly. So the good news for the Fed and Jay Powell is maybe you're going to have an ally in the CCP in China. They locked down because of the thing. Commodities go down and they hand you a gift. The problem is there is inflation in other commodities. Look, for example, at OJ. This is the chart of orange juice, up over 100% year to date. Forget about NVIDIA. To the point where we're now asking, is OJ a luxury good? Why is this happening? Big problem, the crops are down to an 86-year low. And we see another problem with the restrictions of exports from Brazil. And this is not just happening in OJ. This is also happening in wheat. Wheat's down right now because of the Russia-Ukraine deal. But how long will that last if we're going to see a massive reduction in crop here in the US? So the monetary inflation aside, you also have these natural phenomenons that are contributing to inflation rising higher rapidly and sticking. Look at what's going on with food inflation in the UK. Food inflation even here in the US is perhaps the stickiest part. Everybody talks about rents, but food is not going down rapidly. And then you got energy commodities. They're moving higher today. Crude up about 1.5% apiece for both the WTI and Brent. Gasoline RBOB up about 1.75%. The same goes for heating oil. And then you got natural gas. It shows that it's up over 10% today, but that's not really accurate. We just rolled to a new contract, the July contract, which is trading at a premium. We talked about the contango phenomenon in natural gas in a previous video, and therefore when you see roll-ups to new contracts, it is trading at a higher price than the previous one. So nat gas, the new contract is 2.5, almost 2.57, and we see nat gas stocks doing pretty good as of late. Now, here's the problem with oil. We got the Saudi oil minister who came out and said, watch out, we're going to crush the shorts. We're going to have the OPEC Plus meeting. Every time you guys short, I'm going to introduce a new batch of production cuts. Now the shorts say we don't care. Minister, you keep saying this all the time and we keep shorting and oil prices go down. In the last video, I showed you that we have a huge short positioning in oil, which means it's really juicy for a short squeeze in crude oil. But the prince has to play it right. The prince cannot come out in the OPEC Plus meeting and say, oh, we're going to cut rates if the shorts keep shorting. You gotta show something tangible. You gotta actually show the cuts in the data. Otherwise, it's all a bluff, and the shorts are calling the bluff. So the expectations are really high in this upcoming OPEC Plus meeting. If the Saudi oil minister ups the ante and shows something tangible, we could see a massive short squeeze in oil. And the other factor is, now that oil rebounded from, let's say, 71 to 77 right now, did the Joe B administration miss the window in refilling the SPR at the prices that they desired? What are they going to do if we have another short squeeze in oil? All of these are wild cards, folks. You got China, the thing, that's a negative. You got Powell and the upcoming pause, that's a positive for commodities. And when it comes to oil, now you got the upcoming short squeeze. If they play it right, that's a positive. The level of uncertainty and the number of wild cards out there is absolutely insane. And I guess the warning, watch out, is accurate. And when I say watch out for everything. Watch out for all directions. The hit could surprise you at any time, at any moment, with no prior notice. On to the options market, the big casino. What do we see here? The volume all in all, believe it or not, actually went down. And the traders who fell into the trap from last week and they stampeded and poured billions and billions and billions of dollars buying stocks, most importantly, the ones who bought short-term call options. They got hammered in the last 2 days. And the majority of these call options took place in, you guessed it, Tesla. A lot of retail mom and pops bought the 200 calls. I saw even as high as the 250s. Absolute insanity. And the stock went down in the last 2 days. Now we got 2 days till expiration. A lot of these call options are out of the money. They lost 50, 60, 70% of their value. So that's going to leave a sour taste in the mouth of the options traders, and therefore you see the volume down all in all. But it remains high in Tesla, number one, with about 2 million contracts traded today. About 51% of those were calls. NVIDIA, number two, with around 900,000 contracts traded today. About 54% of those were calls. Amazon, number three, with around 830,000 contracts traded today. About 58% of those were calls. And by the way, if you read my morning brief today, there was the risk of a reverse gamma squeeze in Amazon had it traded below 115. So there was a reason why we saw the market maker buying Amazon right off the gate in the morning, because they wanted to make sure it parks above 115. Otherwise, if it goes below 115, you got all of these contracts, the puts, they're going to start to hit, and the market maker will have to sell. So it was a strategic move by the market maker and certain players in the options market to pump Amazon right off the gate. So when you look at the map, and we'll look at the map in a minute, but you'll see the majority of big caps are down, but Amazon is up. That's all due to mechanical reasons. On to the unusual activities that took place in the options market today. We begin with the ticker UBER, Uber. Now, I talked about Uber before, that it is one of the most solid names in the stock market right now because it is a monopoly. But if the stock starts to lose momentum, then it's going to spill a bad leading indicator for the rest of the market and the rest of the economy. Because a company that enjoys this level of monopoly, it only gets weaker if the consumer is tapping out. I don't got any cash anymore. And perhaps we have somebody here hedging for this outcome. Of course, I highlighted the call trade. If you want to look at that one, it's a short-term trade. It's a cheaper one. It's a speculative one. But I look at the put options trade as perhaps a better leading indicator. It could be somebody who owns the stock. It could be somebody betting against the stock. And they bought the 32.5 puts for the expiration date, August 18th, with the expectations that Uber will go down and lose more than 14% of its value by then. They paid about $1 a piece to enter this trade, all in all, spending about $2.4 million. And then we have the trade for the VXX. Now, on Monday I said that I spotted a bullish activity in the VXX, and since then the name popped higher. Now we see somebody fading the rip in the VXX, aka the VIX. And this will be tricky because on one hand, we have the positive catalyst, which is NVIDIA's earnings. And then we have the negative catalyst, which is the debt ceiling and perhaps the upcoming downgrade of America's debt. And the conflict, it'll be really interesting to see how it's going to be resolved tomorrow. Are we going to see a gap and crap? Some big cap names popping higher on the heels of NVIDIA's earnings, then they fade away right away, and we see fear dominating? And if that is the case, we could see an initial drop in the VIX, and then it gets picked up again. Either way, the trade could pay off. In this case, they bought the 35 puts for the expiration date, July 21st, with expectations that the VXX could lose more than 7.5% of its value by then. They paid about $3 a piece to enter this trade, all in all, spending around $1.2 million. Now, if I was the trader of this one, let's say we see the VXX down in the morning. But then we see a gap and crap in the big caps right off the gate. They open gapping higher, they sell them right away. Then I will immediately book profits from the VXX put trade. And then we have BBY for Best Buy. Somebody sees more pain coming for the retailer, and they bought the 61 puts for the expiration date, June 16th, with expectations that the name will go down and lose more than 12% of its value by then. They paid about $1 a piece to enter this trade, all in all, spending around $1 million. And then what about the GDX, the gold miners? We talked about New Mount Gold. It is becoming severely oversold. But can you bet on gold miners when the dollar is ripping higher? We're going to look at the charts in a minute, and it appears that the dollar is a little bit overbought. So it could be a good time to buy the dip in these gold miners. You got to be careful though. And the reason is, if we have a resolution of the debt ceiling, yields will pop higher. If we have a default, the dollar could rip even higher. So you got to be really, really careful with the stops here if you're going to buy the GDX, or any gold miner for that matter. In this case, the trader bought the 34 calls for the expiration date, July 21st, with expectations that the GDX will move higher and gain more than 10% by then. They paid about 70 cents apiece to enter this trade, all in all, spending around $700,000. Then what about the ticker MOS Mosaic? It's been getting hammered as of late, but with natural gas prices recovering, with food inflation sticking, at some point we're going to need fertilizers. And therefore, we have somebody here who sees the name bottoming and moving higher, and they bought the 37.5 calls for the expiration date July 21st, with the expectations the name will move higher and gain more than 6% by then. They paid about $1.33 apiece to enter this trade, all in all spending about $1 million. Last but not least, what about the put spread for the XHB, the Home Builders Index? Again, with rates moving higher, sure, we see a lot of mania on new homes, but these are the cash buyers. The majority of buyers are mortgage buyers. The mortgage rates are now at 7%, and they might go higher. I can see even 10% plus mortgage rates. And if that is the case, maybe it is the time to fade the rip in the XHB. Maybe it is time to book profits in names such as Lennar, D.R. Horton, Toll Brothers. All of these names been winners year to date, but did the time come for booking profits? At least according to this trader, who opened a spread buying the $60 puts and selling the 55, all for the expiration date July 21st, with expectations that the name will go down and lose more than 14% of its value by then, but perhaps not more than 21%. They paid about 65 cents apiece for the 60 puts, and they received about 25 cents apiece for the 55 puts that they sold. All in all, the entry cost is reduced to 40 cents apiece, which brings the total for this trade to about $280,000. On to the heat map analysis. What do we see here? Red across the board, lots of pain, with few exceptions, and these exceptions are some of the big caps held pretty good, such as Apple, Meta. You got Netflix. We saw a lot of unusual activities against Netflix, a lot of folks buying puts, and I put that in the note today, but the effect was actually counter-effective. All of these puts got squeezed, and we saw Netflix moving higher by about 2.5%. Amazon, we talked about why. The market maker had to keep 115 as the floor. And then we got energy. Energy's doing pretty good, at least today. Names such as Exxon, Chevron did pretty good yesterday. The refiners, Valero, some of the natural gas names performed today, so energy is still good for now. It is overbought, overbeaten, for no good reason really. It is the sector that produces the best earnings in the market right now. But because of recession fear, we see energy getting punished. But somehow, recession fears don't impact the most cyclical names in the economy right now. The big caps. Yep, they're not safety. They're the most cyclical names in the economy. Amazon, that depends on the consumer. AI is not going to replace the consumer. Meta, Google, that's advertising. If the consumer is slowing down, these two, one of the most cyclical names in the economy. Tesla, if the consumer is getting weaker, who's going to afford the cars? Same goes with Apple, iPhones. Microsoft may be a little stronger because a lot of this spending happens B2B, but still, lots of exposure to the consumer. But somehow we have the polarity in the market right now where we can punish one sector. It's actually more than one sector. Look at what's going on with metals. It's a wreckage. Look at what's going on with industrials. All of these names are getting hit because we're heading into a recession, but not the big caps. There is some sort of disconnect in such action. And perhaps it's a byproduct of the stagflation that we have in the economy right now. The illusion becomes, okay, we have the recession part of stagflation. That's in energy, that's in manufacturing, that's in metals. And then we have the inflation part of stagflation, and that is still alive in services such as software, such as chips, such as the big caps, at least for now. Another weird move that I got today is AutoZone, AZO, that was down, but somehow O'Reilly was higher. So keep an eye on those two. At some point, O'Reilly is going to catch up with AutoZone and go down. Another notable pick is if we look at defensives, you see Bud Light BUD is down yet again 2% or so, and Target TGT down big. It's getting hammered as of late. And the reason is we know about Dylan Mulvaney, the backlash for Bud Light, and now we have another backlash against Target. They have the swimsuit with the schlong thing. And now the consumer, at least a slice of the consumer, is boycotting Target. So we're seeing a lot of pain here. Now you might ask, hey Maverick, we know why Amazon was up. That was due to a mechanical reason, and the same goes for Netflix. What about Meta? What's up with Meta? Why is Meta up? Meta's up based on layoffs optimism. Zucchini is cutting those jobs so fast, like he's cutting grass. 10,000 here, 10,000 there. You're fired, you're fired, you're fired. To be more efficient. But somehow the efficiency doesn't touch his insane spending on the metaverse. What is it, 20 billion plus a year? But yeah, the efficiency touches the employees. We gotta get rid of the employees, not stopping the insane spending on a fantasy. Anyhow, here's the heat map for the ETFs, red across the board, not looking good today. The exception is energy, XLE, XOP, and if you look at natural gas, UNG, BOIL, all in the green today. Inverse indices, we talked about the SQQs. I booked profits today. I'm done. Good timing because it got NVIDIA up after hours. Now, if we see a gap and crab tomorrow, not in NVIDIA. If NVIDIA reverses back to negative, that would be a historic event, something we haven't seen before. But I'm talking about Google. I'm talking about Microsoft. I'm talking about other big caps because Apple is not really reacting to NVIDIA's earnings. Google up a little bit, Microsoft a bit. If they reverse down, then I might go back and buy some SQQ calls. But for now, we're out. We'll see what happens from this point on. International ETFs down. We got a problem with China now. The lockdowns, FXI, MCHI all down. And with that, look at what happened in European equities. The VGK, the DAX was down today because a lot of the optimism in European equities was due to the luxury brands outperforming. With luxury brands, we're depending on China reopening. If we're going to see weakness in China reopening, luxury European stocks go down, and with it, European indices. So be careful here. Let's do some charts and then wrap it up. We start with SPY, the S&P 500, an hourly chart. What do we see here? We got a gap down today. We went all the way down to 410, which means that the unexplained trade, the pop that we got from that trade is over now. It's been all reversed. The chart got really oversold, so it held on to 410. I'm not surprised by such reaction. And now comes the tricky part. Is the chart about to violate 410 and then flush down all the way to 405? What would be the catalyst for such a thing happening? The answer is the debt ceiling fiasco. If we get a downgrade this time around from, let's say, Modi or S&P, Fitch came out with, okay, we're watching, but we're not doing anything right now. As if to say, hey, Biden, McCarthy, get your shit together or we're going to downgrade. And for you old-timers, you can recall what happened back in 2011. When we got the downgrade, that's when the market started to feel the pain. But there is another case that we could see a move higher, at least initially in the morning, a retest to 413.56 or even closing the gap above. And what supports this outcome is NVIDIA's earnings. If we see big caps moving higher, the AI mania reviving higher again, we could see the S&P moving higher, closing those gaps above, and then we'll see what happens. All what we've done is we've erased the unnatural move, the unexplained move from last week. That's all what we've done. And perhaps a better illustration for you is the daily chart for the E-mini futures. Look at what happened here. We're back within the range. 4100 support, 4180 resistance. The pop that we got last week was a manipulation, and now we're back. Unfortunately, the move sucked in a lot of buyers. We're talking about billions of dollars. I read somewhere north of $8 billion of inflows from retail mom and pops because they got the break. Q's was trading above the August highs from last year. S&P traded above 4,200. That's a technical breakout. A lot of people fell for that, and we cautioned against that in the weekend video. But nobody cares right now, right? Nobody cares. Look at the video, Maverick. It's going to the moon. Okay, what about the rest of the market? And I think NVIDIA kind of buried themselves here. $11 billion in the next quarter? I don't see it happening. You gotta have a tsunami of orders. Will companies really order all of these chips when we have a recession coming and the consumer is getting weaker? I think they made a major mistake today. In the meantime, we're back where we started. Within range, RSI back into negative divergence, so is the MACD. If we have a break below 4,100 this time around, then we know that the break above the range was a trap, and here comes the real break to the downside. The cash index, SPX, 4,100, still support for now, but boy, look at this move. From 4,200 to 4,100 in a matter of days. It happened so fast on the way up, it's happening fast on the way down. This is the power of the mechanical aspect of the stock market, aka options. But options, ladies and gentlemen, have an expiration date. They start and then they have an expiration date, and then their impact is gone. And the problem becomes if the SPX loses 4,100 this time around, it will be the third time in a row when it lost it. A daily closing below 4,100. That will seal the deal for me. And it tells me we're going to go back to 4,000, if not 3,900. So 4,100 is important, critically important, I should say. We look at the Qs, 30 minutes chart. What do we see here? Again, erasing the majority of the unexplained move from last week? Not quite. Had we closed below 328.28, that would have erased all of it. But for now, the Qs became really oversold in the 30 minutes at least. We caught a bump. The NVIDIA action after hours could take us all the way to close the gap above, or even all the way to retest 334.42 as resistance. Then we'll see what happens. A bullish outlook would be a break above 334.42 and a close above that number by the end of the day. The bearish outlook would say what we got is an ABC pattern. The B leg will take us all the way to a retest to 334.42. Doesn't work out. We flush down, forming the C leg. Here is the daily chart for the futures of the NASDAQ. What do we see now? We lost the August high for now, the 13,740.75. We got it back in the after-hours session thanks to NVIDIA. Whether that's going to last or not, it's another story. But most importantly, if the chart loses 13,599, we got a problem because it means that the trend line, the positive trend line, will be broken. And the confirmation will be losing 13,300 as support. Then we got more downside coming. For now, what we know for now, the RSI got really overbought. We got to pull back from that. The RSI is still kind of overbought. It will become even more overbought in tomorrow's session because of NVIDIA. Now, you look at the MACD indicator, it's about to lose the positive momentum, maybe crossing into negative momentum, and that will confirm the break. But we have a really important move in the after hours by NVIDIA, and you don't want to underestimate the power of that move. Let's see how it works. Look at the big caps, the Microsofts, the Googles, the Apples, the Metas. If they start to pull back and lose their gains right away, we got a problem. We look at the IWM small caps, major gap down today, lost two support lines, 177.30, 176.52. Can we retrace some of those losses and maybe close the gap and then take it from there? This is indeed what IWM bulls are hoping for. But I think I don't have to point it out for you. You can see that the formation right now, whether we close the gap or not, is of a head and shoulder formation. And absent of a major repair job, the IWM is going to go down and lose 174.22 again. Dixie, 4 hours. What do we see here? It is becoming overbought. The good news is it caught the support of 103.8. It might lose that in the after hours, meaning right now. And if it does, and we could see a pullback, maybe a retest to 103, this pullback will be good for what? Be good for gold. But right now, honestly, it doesn't look good. I'd be more comfortable if the RSI was severely oversold, just like we've seen back in late February and early March. Right now, the RSI has more room to go. In other words, if the Dixie goes down in a pullback, a technical pullback, but there is no fundamental reason behind why the Dixie is pulling back, then in all likelihood, the Dixie is going to rebound higher again, which means any pop you get for gold is a fake pop, and gold will go down again. SLV silver, breaking the support of 21.57. I'm out of silver now. I made a mistake on Friday. I read it all wrong. I got too excited, bought silver, but perhaps not a good timing. It is a little better than gold because it's getting oversold in the RSI. And maybe this is why I went ahead and I took the risk and I bought SLV, but it could get uglier. If the dollar continues to rip, we could see more pain coming here. So I'm out. 21.57 was my line in the sand. If it's broken, I'm out. But we do have a bullish breakout here in oil. It managed to capture 77 as support. That's the good news. We have positive momentum. The RSI and the MACD. So far, so good, but we need the short covering, folks. If you happen to be oil bull, you want to see the short covering. You want the prince to get out there and indeed induce a real short covering rally, which means no more fake promises. Just do it. Cut the output. You know a recession is coming. You know we have the thing in China now. Cut 1 million, 2 million barrels. For real this time around. And we will see massive short covering. We'll be at 85 in no time. And then the Joey B administration, they lost the opportunity twice to refill the SPR. It went down to their price of about 70 almost. This is of course Brent, not the WTI, but the WTI was down to the 60s. And the Joey B administration lost the opportunity twice to refill the SPR. Here's the 2-year yield. What do we see here? Marching higher, breaking above the consolidation range. We might take this bear flag the moment we see the 2-year trading above 4.59. It's a long way from here. And the question becomes, Are we going to rally from this point on? And then we see the Fed zombies coming out and talking the 2-year down. Now, the big dog, Powell, with the paper and the shaking and all of that, he tried to do that and he failed. What a miserable man. He failed to take the 2-year down. And my hunch is he wanted to take it down on orders, keyword orders, by his former boss, Janet Yellen. Because Janet knows the moment we have a deal, we will see the deluge, the 1 trillion plus of bonds hitting the market. That move alone could, keyword could, push the 2-year all the way to 4.8, if not 5, without a Fed hike. So maybe this is why the Fed wants to skip or pause, because the Treasury will do the 25 to 50 basis points on their behalf. I want you to think about that for a moment. Here's the TLT. Daily chart went down exactly to the support of 100.28, caught a rebound, and now it lost it. You can't buy the TLT right now until we have more clarity. You can't buy the TLT right now until the debt fiasco is resolved. And by the way, a lot of you ask this question on YouTube, on Discord. Maverick, what will happen to U.S. bonds if we have a default? If you want the realistic answer, your bonds are safe. Now, if you have the 1 month and you reach maturity as we get into default, you might have some problems. But if you're holding bonds for 3 months, for a year, 2 years, you'll be fine. They're going to come to a deal maybe later on. There is no possible scenario that America is not going to pay its debt. So the bonds are safe. All of this is drama. All of this is just political theater. Could we get into a technical default? The answer is absolutely yes. But are we going to really not pay our debt? Absolutely not. There is no way this country is going to accept not paying debt. What are the implications in the meantime? The implications are, if we default, is my reading would be yields will go down, TLT is going to shoot higher. So there is a scenario where you want to be bullish the TLT if you believe that we're going to default. And the reason is the demand will not have any supply. The demand will have to be limited to whatever supply we have available, which means the value of bonds will move higher. It means that the deluge is not going to happen. So the value of the TLT moves higher, yields crush down. Another tinfoil hat theory for you. Maybe this is what the Fed actually wants. Maybe a technical default for a day or two, for a week or two. Maybe that's the resolution that's going to crush the 2-year for the Fed. Because right now, it refuses to go down. Right now, it continues to rev higher. And that's problematic for the Fed, because it means that they have the cover to raise 25 basis points in June and risk, of course, the deluge from treasuries. And oh, by the way, banks are going to blow up. I've been watching the bond market for years, folks, and this is the most interesting I've seen it in at least a decade or so. Unbelievable action. When we look at the VIX, 4 hours chart, we got the breakout from the bull flag. We're now above 20. Is it going to keep 20 or not? Here's my reading for the VIX bulls. You're hoping for an ABC pattern. You're hoping for a pullback. You might lose 20 momentarily, at least in the morning, because of NVIDIA's earnings and the rip in the Qs. Then we see a gap and crap, and the VIX revs higher. If you're bullish the market, bearish the VIX, you're hoping that this is it. The VIX is not going to make it above 20, and we're going to see it moving down back to 18. What about Apple, the big kahuna? What do we see here? The head and shoulder formation, or the bear flag formation that we talked about on Monday, it did play back and gave us a decent pullback. And Apple lost support for a little bit, but then regained it again. It is actually exactly at support. It was oversold for a little while. Now it fixed all of these oversold conditions. So you look at the MACD indicator, it's about to produce positive momentum. The bullish outlook would say we pop above this line, which is resistance right now, retested as support, and then rev higher again and close the gap from above from the bear flag pattern. The bearish outlook would say, no, this resistance is going to hold, and what we're going to see is an ABC pattern. So this is the B leg, and then the C comes out, and we go down to 167.88. Which one is more likely, given NVIDIA's earnings, given the MACD indicator? I would say the bullish outlook, or it could be a combination of both. We could see a crack above the support line, but that would still be the B leg. And then we go back in the retest to the support line. It doesn't hold, and that forms the C leg. And the same goes for Tesla on hourly chart. What do we see here? We talked about it being oversold on Monday. We got a decent pullback all the way to 180 today. 180 was critical support to keep, and the reason is there was a real risk of a reverse gamma all the way to 170 had the chart traded below 180 for, let's say, 2 to 3 hours. But it managed to recapture 180 as support by the end of the day, so this scenario has been averted, at least for now, keyword for now. We look at the pattern, it is of a bear flag pattern. We look at the RSI, it is curling down, indicating sooner or later, bear flag plays out, 180's lost its support, and down we go to 170. But what if NVIDIA's earnings somehow rescue Tesla? Is there a bullish scenario? The answer is yes. We could see Tesla moving higher, closing the gap in the morning, and then we take it from there. If it trades above the gap, so far so good, back to being bullish. If it gets rejected and pulls back, then breaks 180, forget about it. And the reason is, if we clean up the chart and we use a line chart instead, even if it goes all the way to closing the gap and it stalls right there, it could be forming a head and shoulder formation. So be careful here. Those of you who are buying call options out of the money, 200, 250, you're insane. You're relying on a gamma squeeze. And that happens for a little bit, but to sustain a gamma squeeze, you need more and more volume. And at some point, it becomes impossible to keep, especially if a lot of those holders of call options capitulate, they close, or switch to puts, which I've seen a lot of today. Bitcoin, tulips, daily chart, what do we see here? Not looking good here, folks. It appears that it lost the support, 26,555 at least at the time of the recording of this video. But the day is still young, and will the AI mania, the NVIDIA pop after hours, help Bitcoin? Kind of a long shot. So you gotta be really careful here, because the moment we get a real indicator that this support is broken for good, we will see a flush down. And that could take us all the way to 24,000, if not all the way, my number at least, 23,189. Moving on to the conclusion of this video, what do we have on the economic calendar tomorrow? We got GDP, a second reading, watch out for the revisions, and then we have initial jobless claims. This is really important. The fluctuations have been absolutely insane in these kind of readings. Then we got pending home sales and more zombies from the Fed. This time around, Richmond President Tom Barkin and Boston Fed President Suzanne Collins. With that, folks, this is all I got for you for now. Thank you for listening, thank you for watching, and I will talk to you again tomorrow. Good night.
Don't declare war on Congress, Mr. President.
Not on Congress. I'm declaring war on atrophy. But these days, who could tell the difference?
behind. Some days go so fast, some days